How do you predict the future?
Yeah, look, very good question, because in business you have to, like managing your cash flows, managing your P&Ls, managing your growth, you've got to try and predict where the industry's going, where the regulation's going, where AI is going, where's tech going, where your staff want to go. You've got to predict it in some way, shape or form. The reality is you can't sit here today. My decision making today is not really today. I don't make decisions for today. I'm making decisions for the next 6, 8, 12, 10 years, right? But all those decisions I'm making today are going to impact all that period. And I've got to predict, okay, what do I think is going to happen in year 3 from now? And I've got to build the strategy around that, because it takes so long to invest, right? Or if you're going to do a tech piece, it's got to be built for the 3-year period, because there's no point building it for today. So then I've got to look forward 3 years, go, well, what's regulation going to be like? Who are my partners going to be? What's my staffing arrangements going to be? And put all of that together to make the right decision. And
Welcome back to the Winner's Playbook. Today, I'm joined by someone who doesn't just talk about building businesses, he's actually done it. Steve Sloane is the Managing Director of Link Wealth Group, which brings together 4 distinct businesses under one roof: financial advice, finance broking, accounting, and Libera Solutions, our Philippines-based financial services outsourcing business. We've got a big episode today. We're going to start with a story from the AFR this week that every business owner should know about. A record $11 billion bet being placed against Australia's big 4 banks. Then we'll get into how commercial lending actually works in Australia, the mechanics, the risks, and what the banks don't put in the brochure. And we'll close on what I think is the most important and underrated skill in business: capital allocation. How do you decide where your money goes, who has a say, and how do you make those calls when the future is uncertain? Steve, welcome to the Winner's Playbook.
great to be here, Billy. Thanks for the invitation back, mate. It's been a while. I felt like I was losing my my flair there for a while when I got ditched off the podcast, but I'm back now, so it's good to be here.
Excellent, good to have you. So before we get into talking about running a business, there was an interesting story in the news this week. Did you get onto that one?
I did, yeah. That was interesting, especially with the headline of what it was saying about the bank. So yeah, very, very interesting.
Yeah, so essentially they were saying there's been an $11 billion bet against the banks. This is big hedge funds have placed a huge short bet against Australia's big 4 banks, the biggest short bet in history. So that's CBA, NAB, Westpac and ANZ. There's 4 reasons they've done this. One is due to rate hikes and mortgage stress. The other is the negative gearing changes we've seen coming recently, or being proposed anyway. Margin compression, so the bank's making less profit, and stretched valuations. So what do you reckon? Are they making the right call with these positions?
Yeah, look, potentially, right. They're some of the most expensive, if not the most expensive banks in the world. Value for money and income you're deriving off your investment, if you're buying those shares, is pretty minimal from a yield perspective, and there's a lot better yields out there that we know about. And look, it's a very unknown landscape with the labour changes and what's going on with housing. And clearly housing has increased just dramatically in this country in value. The banks have collected that margin on the value of the debts they've put out there to collect interest on. Whether that's going to continue forever, well, probably not, right? So they've had a massive run. I personally wouldn't be buying them, but I can't really say that on this. But, I think it's probably timely to really review your portfolios out there, especially with the banks.
Yeah, it's a tough one because like CBA has been bothering me for a number of years because you get clients regularly, right? They've inherited CBA shares all the time. They've got these massive holdings in Commonwealth Bank and they're just so emotionally attached to it.
Yeah, you can't have the Dolomite accounts, right?
Exactly. And like you can't, as an advisor, you can't tell them to go sell it all because if you're wrong, they're never going to cook to it.
That's right.
But if we look at how they're valued, CBA shares are trading at a PE ratio of 25 times. You compare that to JP Morgan, the biggest bank in the world, that's trading at 15 times. And Lloyd's Bank in London is trading at 13 times. So, what does that mean? It means CBA, you're paying double. Double what you pay for a bank in another country. So if those short bets pay off, that share price has got a long way to Pretty long way to fall.
Long way to come down, and you're paying double and your yield's not that good either. So the income you're getting from the dividends sometimes can be not that great if you're paying that huge amount for initial shares, right? So yeah, look, it's if you compare around the world and you've got to do that, then they're very expensive.
Yeah, that's it. And like people used to buy for the yield, right? Like little franking credits.
Yeah.
But today you're getting like 3%.
Yeah.
And your savings account's getting 5%.
Yeah.
It doesn't stack up.
It doesn't stack up. No, look, I think 10 years ago it probably did. Because the yields share price was nowhere near, or maybe 20 years ago. Yields are obviously based off the share price you're paying. So the higher the share price, the lower the yield goes. So yeah, it's probably timely that people out there really review what they're invested in here.
100%. All right. Well, let's get on to the more exciting stuff. Actually, sorry, before we finish on that. So what does that mean? Like, so say these short bets pay off, the share price falls. Does that impact on, do you reckon, like on businesses and homeowners in terms of them actually getting finance from the bank?
Oh, no, I wouldn't say so. I don't think that's a risk at this stage. It'll just mean a bit of pain for the shareholders. And especially if you bought in the last couple of years, there'll be lots of pain for the shareholders. But no, I think we're pretty safe there with lending. I think there's external factors that will go into that particular issue. If there's a real lock-up in the economy and the economy starts to really take a hit with unemployment, whatever that may be, that's when the banks will start reducing how much risk they're exposed to.
Yeah, and one issue is like they're so reliant on lending for homes.
Yeah.
Whereas in other countries, the banks might do more with businesses and so on.
Yeah.
Which leads us into the main topic here.
Mm.
So if the banks are under pressure, what does that mean for businesses borrowing money? So let's talk about commercial lending.
Yep.
Like, because that differs, like compared to say going to get a home loan. Commercial it's a completely different story.
It does.
Mm. So what is commercial lending?
Commercial lending, I suppose, is really anything outside residential, right? Instead of buying a normal residential house, everything else, apart from your personal loans, credit cards and car loans, etc., is really commercial. So you're talking about lending to businesses, cash flow lending, buying assets for businesses, commercial property lending, etc. So it's really outside the residential market is pretty much your commercial market. And it does differ significantly. You know, if you buy a residential house, you've got the property value and the income to look at, and then can you pay the loan with that income plus your wage that's coming in? That's pretty much about it. Yeah, they'll look at your expenses and work that out, but it's pretty simple, right? Commercial lending completely different. You've got to go through, and I know this because we have quite a bit of debt through the business as well as property debt, etc. Commercial lending is all about forecasts, cash flow forecasts, P&L reviews. You know, P&L line items get reviewed. Serviceability obviously kicks into gear. Can the business afford to pay it? Then you got to chuck in personal guarantees by the directors. I know I'm personally guaranteeing every dollar owed to the banks here, and that's a huge risk for me. So that goes up and down, but there is so much that goes into it. And I must say this: I've recently had I won't name the bank we're with, but it's one of the big four. And we've had a terrible experience, to be honest with you, recently, where they try to really lock up our money and for no apparent reason. We're profitable. We pay all our debts for 14 years every minute. So, but that's the way it goes, and you've got to work with that, and you've got to work with the bank because there's no point ignoring the fact you can't work with them. If you get on the wrong side of them, they can call in your loans, and that's not a good thing either.
No, and so how do they actually look at servicing? Because obviously if you're buying a house, it's pretty simple. It's just salary or business income or something, or rental income.
Yeah.
If you're like, so say you're running a business and the business doesn't own property, you just want to grow, you need capital to grow that business.
Yep.
How do they look at that, and look, like what sort of LBRs can you get?
Yeah, it definitely depends on the type of business. So we run a financial services business, and the way they value the business and the LVR position, it's different for financial services businesses to manufacturing businesses to every other business. So they'll have their policies, if you like, for financial services or any industry for that matter. Generally, it's on a EBITDA multiple. So you take your earnings minus your tax and debt, etc. Multiply that out times 3 or 2.5. That's EBITDA. Sometimes I'll do recurring revenue multiples. Most of the time it's EBITDA. And that's the way they, then they work out how much debt they'll give you to go buy something, or lend off the equity that you've got. And then you can go buy more assets for the business. For us, we buy client books and the like that have recurring revenue. That's the way they look at it. But they also look at all the fundamentals of the business. Where's the business going? Who are the directors? Do they perform? They really get into the details. So and it's sometimes quite uncomfortable. Once because if you go get debt off the bank, you're really open to everything. You can't hide anything. You've got to tell them your life story over and over, often 5 times the same person. So yeah, it's quite in depth. There's a lot to it, but I suppose I've been doing it now for a long time, and the more you do it, the better you get at it. Sort of bank policy. We're fortunate here. We've got Mark Stone, one of our BDMs for Levura, ex-old bank man, so he's quite attuned to what we need to do with the bank. So yeah, that's the way it works.
Okay, so that's servicing, and then you mentioned security as well, like personal guarantees and all that sort of thing. So what do they do there?
They pretty much lock up all your assets personally as a director. That's the unfortunate thing about being a director. You realistically, you're on the hook for absolutely everything. And if the business itself can't pay the debt, they can come and take all my personal assets. So that's the way it goes. You can try your hardest to get out of that personal guarantee. Really difficult. If you get your loans really low, potentially you can take off your personal guarantees. But realistically, unfortunately, in Australia, most directors are probably tied up in this where their houses and stuff are wrapped up in the debt. So that doesn't mean the business has to pay those personal assets. It's just if something goes wrong, those assets
come after everything else.
So you're on the hook.
And is like, do you know if that's how it works in other parts of the world?
Good question. I don't know, to be honest with you. I assume it probably would be similar in the Western world. Look, the American banking system is very different where you can sort of walk away from loans where we can't do that here. So it might be a little bit different there. But I know in England it's very similar because I've got family living over there and some of my family own businesses, and it sounds very similar. But yeah, around the rest of the world, I'm not too sure.
Okay. And you said they look at your personal character, and what's that about? They look at your history and if you've had any credit issues and things like that.
Yeah, absolutely. You make sure you're not a criminal because I'll look at your criminal records. Everything goes into it. I suppose I look at your cash flow, also your personal income. What do you pay yourself? How do you make money? What your asset base is at the age of 45 years of age? Can you function correctly as a director? Have you stuffed up businesses in the past, and is there any issues on title about that, or bankruptcy, or it may be? So, yeah, you go through the ringer.
And do they so what happens when it goes wrong? Like if you default on payments and things like that, what's the leeway there?
Yeah,
so we'll do a home loan.
Really, that's the part I don't want to. Well, no, I don't. But it's the part you don't want to think about. To be honest with you. Look, I'll be honest with you, I went through the Royal Commission in 2018. I was told I was bankrupt overnight, supposedly, and got myself out of that. So it wasn't a nice feeling. What happens? They call the money in, right? So if you don't pay the bill, they request all the money paid back. And if you don't have the money in the bank to pay it back, well, they can make you bankrupt. So it's not a good position to be in, that's for sure. So, my job and everyone else's job here is to make sure we run the company as a going concern, and keep it profitable and moving forward, because the alternative is not what you want to do.
And do they ever and this might be a recent thing, do they ever just want you to pay back part of the loan, like just call in some cash? So we're not comfortable with the debt levels at this particular moment for any reason. Give us a couple $100K or what?
Yeah,
what do they do?
That can happen.
Up for cash every year?
Yeah, that can happen. Well, you're supposed to generally, when they give you debt, they'll want ongoing reporting. They want to see your ongoing P&Ls and balance sheet, etc., back to them. If they don't get comfortable with a certain position, they'll let you know, and they'll say, right, we need some money paid back here. You want to hope that amount's not too big, or you don't have the money in the bank to pay it. I personally have to make sure I've got money outside the business in other bank accounts if that happens, right? Because as the managing director, if the business can't pay it, the reality is I've got to pay it. Right. And so people say, geez, Steve, you might be wealthy, but no, it's not the case, right? Because I've got to have money there to pay if something goes wrong, effectively, and no one else has that responsibility apart from me. So it's ongoing battle that way.
And so who are the players? So you got the big four banks, so they in small, medium business land, do they dominate, or are there other banks?
Yeah, look, unfortunately, and this is probably a bit of a problem, right? There's not a hell of a lot of competition. There are some other banks like Judo, Macquarie, some other sort of, we'll call them mid-tiers, I suppose. So, look, there's more out there coming. I wish there was more, to be honest with you, more competition would be nice, because the bigger end of town definitely ties up a lot of the business. And so they know that. Competition's always good, so I wish there was more of it.
Okay, so we're spoken about lending. So you've got the money, right? Whether it's bank debt or otherwise. So let's talk about running the business. And you've now got, how many businesses do you feel, like 4?
We're 4 businesses, yeah. And we're sort of bolting on some more with the academy, advisory academy, and things like that. So, but 4 majors at this stage.
There'll be at least a couple more coming, right?
I'd say so. Yeah. I get bored.
Okay, so let's talk about the different stakeholders.
Yes.
So it started with 1 business, I guess, and now it's 4, might be 5 or 6 in a year or 2.
Yeah.
So who are the key stakeholders that you have to manage?
Well, I think there's so many of them, right? There's staff is your major one. There's clients is this major one. Then you've got staff, and you've got equity holders, right? Shareholders of the business, and then you're one of those, Billy. I've got to manage the shareholders and make sure they're happy and understand the vision we've got and where we're going, because if you don't explain that well to the shareholders, that can be really upsetting and not work. But then I've got external counterparts or colleagues in the industry we deal a lot with to work together to get better business, have to do business together a lot, Inside Network and Colonial and the likes of those people. So then we've got external and then you've got the banks you've got to deal with. Then we've got suppliers we've got to deal with. And then we've got big tech companies and AI agents and all that sort of stuff we've got to deal with. So we probably deal with in a year 500 different stakeholders, right? And they all want different things off you. They all want different, shareholders want dividends and growth of capital.
Well, that was my next question, because each stakeholder has a different set of priorities or things they want from the business. So shareholders might want dividends. Obviously, they need to see the vision of the business. They can say, okay, I don't need a lot of dividends because I can see the business is growing, so I'm happy. So that's shareholders. Then you've got yourself, when you're like the founder, essentially. So what's your priorities? Growth.
My priority is growth. My priorities, my 2 major priorities is getting the right people in the business. We've now got 150 staff, right? My job is to make sure we've got the right people, the right culture, full stop. That's got to be my major priority. Secondly is growth, right? But growth in the right way. We just don't want growth for growth's sake. It's got to be the right growth with the right people at the right time. Sometimes there'll be some years you don't want to grow too quick. And the reason I say that is because the tech is moving that quickly. You want to sort of time it that you get the tech right with the growth right at the same time. Because if you stuff up that combination, it can be dire. So yes, we want to grow. We want to do it in a consistent manner, but in a way that is at the right time. We need to grow year on year. There's no doubt about it. Some years you want to really, if you nail a year, you need to execute hard on that year. And then some years it'd be okay to drop back a peg, right? If we're waiting for something to happen or an acquisition to happen or whatever it may be. So, but yeah, that's my 2 big priorities. Obviously I've got to look after shareholders at some stage and make sure there's a profitable dividends being paid, because that's my job too. And then execute the strategy. I've got to execute. So we deck out a 10-year plan. We've got to nail it.
Okay, so that all makes sense. So that's your priorities. You got shareholders. Employees are different.
Yep.
What do employees want? They're going to pay the bills, right, first and foremost.
Yeah, they are, and they've also got to buy into your vision, and that's difficult. It is difficult because I could sit here and say, look, this is the vision. This is why we're doing it. This is how we're going to do it. This is why we're going to do it. Whether they believe it or not, though, that's not a thing, right? So so half the time I've got to repeat what I say a lot to my team here, my team in the Philippines especially. But you got to get buy-in, and they all want a career growth. My job is also to grow their careers, because if you're not growing their careers, they'll leave. You don't want good people leaving, so we need to make sure we're constantly growing. Hence why you got to keep growing, right? So there's shareholders growth reasons, and then there's growth for staff, and they're 2 different worlds. And if myself and Josh don't grow this thing, and the likes of yourself, Billy, with what you're doing, yeah, we're going backwards.
Yeah, and I'll do like side story. This is why I joined this business when I first spoke to you 6.5 years ago.
Mm.
The business I was at before, good people, great business. I was on track to becoming a shareholder there, but it wasn't a right fit because of the vision that they had was different to what I wanted to be involved in.
Right.
Yeah. So that's the reason I switched.
Yeah, okay. Yeah.
You know, and so it does, bothers you sometimes with high performing employees when they don't realize that that's actually a really important factor in figuring out who they want to work for.
Yeah.
Because that's otherwise you're not going to get job satisfaction, right?
No.
You need to see the vision and the growth and all that stuff, not just, all right, that guy's going to pay me 10% more or bonus or whatever.
That's right. The 10% can disappear pretty quick, right? With chasing
the tax.
Yeah, totally. Yeah, no, that's because I remember that. Look, I personally think if you're not working for a company that's grown significantly and doing different stuff, you're going to get bored. Yeah, and actually 20 grand if you're bored, it's not going to be much. Yeah, so.
Spot. All right, so they're all the stakeholders, and there's tensions between them at times. What's the biggest or hardest sort of tension to manage? Is it between employees and founder, or
look, it's probably just obviously staff want more pay.
Yeah,
shareholders want dividends, and suppliers and banks want to be paid, and the ATO, right? So it's just that managing cash flow. I'll say this sounds real easy. It's really not. Because you constantly got to manage, forecast growth of staff numbers because you want to grow. Then you got wage increases. Then you're trying to do dividend distributions. Then you're trying to forecast expenses. Then you're trying to keep the ATO happy and the banks happy. And it's a cycle every week, right? It's extremely difficult to manage that, because you got so many forces wanting more and more and more. And then you got people wanting to do business with you that want more. And you've got to work out if there's a payoff by doing that with a business, and should I be using that money to do something else with it? It's challenging. So but it's normal. That's normal business, and that's expected. And to be honest with you, that was expected from day one. I knew that was going to be the way. But getting that balance right, and the only way I can do to fix it is just got to communicate really well, and speak to people, be open to people, have an open door policy. Anyone can talk to you whenever they want to, and understand your reasoning to do stuff, and know why you're doing it. Really know it, because you're going to be asked the questions. So know your stuff.
All right. So that's a bit about managing stakeholders and the conflicts and so on. So let's talk about a bit more about the capital allocation. So firstly, what are your options in terms of sourcing capital? Like we've spoken about bank debt. Yeah. So there's other ways to get a hold of capital.
Yeah, there is. And one of them that we haven't touched on yet or done yet in this company is private equity, which is pretty much private money, if you like. A lot of businesses in Australia, especially in financial services, are tapping that resource for capital. They've got lots of it, right? Clearly, but private equity overseas is looking for where to place it. We haven't done it yet because, again, they can restrict you a little bit with business. Control, yeah. So you've got to be careful. But that's one way to do it. There's also personal funding through existing shareholders. You can do that, or through me or whatever it may be. But most of the time it's through banks, or you can cash flow it, right? So if you've got enough cash flow, you can finance it through cash flow. So, if you want to go do an acquisition, you've got the right cash flow to be able to do it, or you can do it through the business itself and not after taking a lending. Or there's a combination of everything, right? So some from the bank, some from shareholders, some from private equity, and some from someone else. So, these days there's a fair bit of capital flowing around to find a home in, and people are searching for good yields. People are searching for good businesses to invest in. So as long as you know how to run a business properly, you can generally attract capital. We've got lots of people trying.
Yeah, and does that sort of ebb and flow? Because I've been reading a lot about SpaceX, right? Yeah. So they're raising $100 billion, or whatever they used to raise from retail investors. Yeah. Insane valuation. Yeah. So now the other AI companies are going to go, sweet, we'll jump in on that too. Yeah. They'll IPO and raise more money. So it's going to suck up all this capital. Yeah. So there must be a bit of a cycle in terms of when it's easier to raise capital versus when it's tough.
Yeah, I've seen cycles. I've seen the cycle. Like there was a period there after TF's when the Royal Commission hit that there was no capital. Yeah, zero. Like you couldn't get a dollar. Trying to refinance your bank loans is impossible, right? And so I've definitely seen the cycles. And geez, it would take one of those tech companies just to blow up, and that would suck up the capital again, right? There'll be no more capital to
Disappear.
because everyone get nervous. So it definitely goes in cycles. Right now we're in a bit of a sweet spot with financial services in Australia because the regulation's good, governance is good. I've been around the world, looked at advice businesses all around the world, and we've got the best by far. So people are looking at that, wanting to invest in it. So I don't think we're going to see a shortfall of capital in this space for some time yet.
Well, interestingly, we've probably seen a safe now, right? Whereas 20 years ago, it was a riskier proposition.
Yeah, that's right.
Financial advice business.
Yeah, 100%. So we're actually seeing around the world, we're seen as a really well-run, regulated industry here that people want to park their money into. So, even with the SpaceX and all that sort of stuff happening, with the big pension funds, they've got money too, they want to invest in, they can't find a spot to do it.
Okay, and then you raise capital. What's the decision-making process around where to allocate it? Because you can pay dividends, you can make an acquisition, you can hire more people. Like, how do you balance all that? And
again, we do a lot of work here as a group on the strategy for the company, especially the next 2, 3, 5 years, where we want to go to. That has to clearly come into it. So what we need to grow in, what areas we need to grow in, what are the 4 businesses we need to grow more than others, where do we need to invest in the back office, where do we need to invest in tech, do we need to build our own CRM? So that strategy we look at every month, I'd say. We've got an overall arching strategy, but that strategy we review every month. And so that capital decision will have to have that factored in. But then it's other decisions, right? Yes, we want to grow. There's some great acquisitions out there that we want to take on, and that acquisitions are part of the overall strategy. So when do we do the acquisitions? We may use it. Some years may not. But again, it's like that balancing act I said before between stakeholders and the 500 odd that I deal with each year. That comes into it. So there might be dividend for shareholders. It might be the right time to do it. But I've got to communicate that. I've got to be very clear on that strategy and why we're spending the capital. So my job is to report to a board and say, this is what we're going to do with the money. And generally, you need to, board approval above a certain amount of money. But yeah, it's a balancing act. Like everything in business, it's a balancing act. And but as long as you stick to your guns, you communicate well, and you execute on that strategy, then people believe in the vision.
Yeah, and what are the mistakes that you see with capital allocation in other businesses, or ones you made yourself?
Waste of money, like making the wrong decisions on capital spend. So, the worst thing you can do is go build something or buy something and it blows up and doesn't work because you just don't need DOS, right? So if you're paying down debt, fine, it's simple. It saves you money, so great. If you pay that distribution, it's fine. And your shareholders are happy, all cool. But if you just went and bought the wrong business and it blew up, or you build a tech piece and blew up and you just completely dusted the cash, that's an issue. And look, I've seen it happen. I've seen people buy businesses and blow them up. So especially in financial services, you probably would have seen after Royal Commission, a lot of people went bankrupt, right? So that means you are gone to zero.
And we've seen, like in our industry or profession, not naming names obviously, but we've seen some groups where they're sole. All they're doing is acquisitions, right? They're going around buying up lots of small financial plan businesses, and then the integration part is where they're cooked.
Oh, mate, I've seen it. I've heard it and seen it so many times where you go by these businesses, you bolt them on, the cultures just blow each other up to start with. So the staff will leave and the advisors will leave and you've got no advisors. And then all of a sudden there's a mass exodus of clients. You've all of a sudden gone from an LVR of 50% to 100%, 150% debt ratios. And blown up. So I've seen it so many times. So it's so critical to do your due diligence and buy the right businesses and know where you can add value. And so when we buy businesses, we really do a lot of DD. Sure, we don't get it 100% right all the time, but we don't blow them up, right? We always make sure they're sort of, at the very least, we've made some money. Ideally we want to make a lot of money, but sometimes we're not going to get it right all the time. But as long as you don't blow the thing up, that's the critical part.
Yeah, and part of it's around this business life cycle, right? Capital allocation. Like if you're starting a business, you're not paying dividends in the first month.
Yeah.
And if let's go back up to late stage business, right? They're all about dividends. They don't have a better use of the capital, right? They're just paying it out to shareholders every year.
Yeah.
So how has that evolved since you started in capital allocation?
Yeah, it is. And like you said before, it is a bit of a journey. Like some years you can do a lot of distributions because you're not doing acquisitions and you're not building stuff. This thing costs a fortune that we had to spend, and it's a
building we're in right now.
Building we're in right now. So, and so there's going to be some years are good, some years are not so good for that scenario. Again, communicate to your shareholders why. But absolutely, first couple of years of business, I was eating out of a needle box. There's no money. So obviously, as the journey goes on, you build the business, you build the foundations. We've built a big business here now, and then that allows you to really scale up. Right. The idea is we wanted from day one to scale up, to execute and get bigger, and then look at it wasn't the first 15 years; it's the next 15. Right. That's the big one. So that's what I'm looking for.
How do you predict the future?
Yeah, very good question.
I probably should have sent that question to you before I asked.
Yeah, look, very good question, because in business you have to. Yeah, like managing your cash flows, managing your P&Ls, managing your growth. You've got to try and predict where the industry's going, where the regulation's going, where AI is going, where's tech going, where your staff want to go. You've got to predict it in some way, shape or form. The reality is you can't sit here today. My decision making today is not really today. I don't make decisions for today. I'm making decisions for the next 6, 8, 12, 10 years, right? So, but all those decisions I'm making today are going to impact all that period. And I've got to predict, okay, what do I think is going to happen in year 3 from now? And I've got to build the strategy around that, because it takes so long to invest, right? Or if you're going to do a tech piece, it's got to be built for the 3-year period, because there's no point building it for today. So then I've got to look forward 3 years, go, well, what's the regulation going to be like? Who are my partners going to be? What's my staffing arrangements going to be? And put all of that together to make the right decision. And it's extremely challenging, as you can imagine.
Right, but before we wrap up, is there one thing now about running a business that you sort of think you wish someone had told you a while back?
Yeah, just good question, Billy. Why didn't you send me that before? Look, I think definitely the one rule, culture is king. Like I didn't put enough emphasis on that when I started the business at all, right? And it took me 5 years to work out I had to. And now we live and breathe it. As simple as that. If you don't have the right culture in your staff, you don't have a team. That's someone fire quick, hire slow. I didn't fire quick enough, and I hired too fast in some ways. And getting the right people in the right seats is a big job. It's a critical job. You've got to make sure you got the right people on the bus at all times. That's the 2 things I'd probably take away from my learnings over the last 15 years or so.
Awesome. All right. So we've covered a bit today, really the full life cycle of capital, how banks lend, how businesses access that money, how smart operators decide what to do with it. So we'll call it there. And thanks, Steve, for jumping on. Great chat.
Pleasure. It was great to meet you.
Josh, the business partner, Josh is happy that I asked you the hard-hitting questions. Yeah, he asked me to do it.
I'm sure he would have asked that question, and I told you to do that. So thanks, Josh, and he'll be in the hot seat next time.
Awesome. Well, thanks for listening to the Winners Playbook. Follow the show, leave us a review, and we'll catch you in the next one.
All right.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.